Let me tell you something that most investors completely miss about retail. They think retail is dead. They think Amazon has destroyed every store with a physical presence. They think the only way to make money in retail is to avoid it entirely. And I understand why they think that. Over the past 2 decades, we have watched legendary retailers collapse into bankruptcy. Sears, a company that once defined American commerce, gone. J.C. Penney, a department store that served generations of families, bankrupt. Toys R Us, where millions of children experienced the magic of choosing their own toys, shuttered forever. The list goes on and on. Bed Bath & Beyond, Circuit City, Radio Shack, Blockbuster. Names that were once synonymous with American shopping have simply vanished. So when people tell me that retail is uninvestable, I understand their logic. But their logic is fatally flawed. Because within the carnage of dying retailers, there are a handful of companies that do not just survive recessions, they thrive in them. They do not just endure economic chaos, they emerge stronger from it. And today, I am going to share with you the 3 retail stocks that I believe will prosper regardless of what the economy does. Whether we have inflation or deflation, boom or bust, these 3 companies will keep generating cash, keep gaining market share, and keep rewarding their shareholders. But before I reveal these 3 retailers, let me explain something crucial about why most retail investments fail and why these 3 are fundamentally different. Because if you understand the principle behind my choices, you will be able to identify similar opportunities for yourself. This is not just about giving you 3 stock picks. It is about teaching you how to think about retail investing in a way that will serve you for the rest of your life. The retail industry has a fundamental problem that most investors never fully appreciate. It is extraordinarily difficult to build a sustainable competitive advantage in retail. Think about what a typical retailer does. They buy products from manufacturers, they put those products on shelves, and they hope customers come in and buy them at a markup. So that is the business model. And the problem is that almost anyone can do it. There are very few barriers to entry. Anyone with enough capital can lease retail space, stock shelves, and open their doors. This means that whenever a retailer finds a profitable niche, competitors immediately rush in to copy them. The profit margins get squeezed, the competitive advantage disappears, and before long, the retailer is struggling to survive. This is exactly what happened to department stores. For decades, they had a wonderful business. They were the one-stop shop for American families. You could buy clothes, appliances, furniture, cosmetics, everything in one convenient location. But then category killers emerged. Stores that specialized in one thing and did it better and cheaper than the department stores. Best Buy for electronics, Home Depot for home improvement, Bed Bath & Beyond for housewares. Suddenly, the department store model was under attack from every direction. And then Amazon came along and delivered the final blow. Why drive to a department store when you can order anything online and have it delivered to your door? The retailers that died all shared a common flaw. They had no sustainable competitive advantage. They were competing purely on convenience and selection, and those advantages were easily replicated and eventually surpassed by competitors. But the 3 retailers I am about to share with you are different. Each one has built something that competitors cannot easily copy. Each one has what I call an economic moat, a durable competitive advantage that protects their profits year after year, decade after decade, regardless of what the economy is doing. Let me take you back to the 1960s, when I first started thinking seriously about retail investing. Back then, the retail landscape was dominated by different names than today. Woolworths was still going strong. Montgomery Ward was a household name. Kmart was revolutionizing discount retail. The mall was becoming the center of American social and commercial life. If you had asked investors in 1965 to predict which retailers would dominate in 2025, almost none of them would have gotten it right. Most of the companies they would have named no longer exist. The lesson from this history is that retail changes constantly. What worked yesterday does not necessarily work tomorrow. And yet, some companies do endure, some companies do adapt, some companies find ways to not just survive, but thrive across decades of change. Those are the companies I look for. The first retail stock that thrives in every economy is Costco. Now, I know what some of you are thinking. Warren, Costco is not exactly a secret. Everyone knows about Costco. The stock has been a great performer. Is there really much upside left? And my answer is yes, there is enormous upside left, because most people still do not understand what makes Costco so extraordinarily special. They think Costco is just a warehouse store that sells things in bulk. That completely misses the genius of the Costco business model. Let me explain exactly what Costco does that is so different from every other retailer. Costco does not make money by marking up merchandise. I want you to really absorb that statement, because it is the key to understanding everything about this company. Traditional retailers buy products at wholesale prices and sell them at retail prices. The difference is their profit margin. A typical retailer might buy something for $60 and sell it for $100. That $40 markup is how they make money. But Costco deliberately keeps its markups as low as possible. Their company policy is that no item can be marked up more than 14% above cost. Most items are marked up far less than that. On average, Costco's gross margin is about 11%. Compare that to a typical retailer with gross margins of 30 to 40%. So if Costco barely marks up its merchandise, how does it make money? This is where the genius comes in. Costco makes almost all of its profit from membership fees. To shop at Costco, you have to pay an annual membership fee. The basic membership costs $60 per year. The executive membership costs $120 per year. And here is the remarkable thing. Costco has over 130 million cardholders worldwide, and the renewal rate is over 90%. Let me say that again. 90% of Costco members renew their membership every single year. That is an astonishingly high retention rate. It tells you that members perceive enormous value from their membership. Now think about what this business model means. Because Costco makes its profit from membership fees rather than merchandise markups, it can sell products at prices that competitors simply cannot match. Walmart cannot match Costco's prices because Walmart needs to make a profit on the merchandise. Amazon cannot consistently match Costco's prices because Amazon needs to maintain margins. Costco can sell products at essentially cost because the membership fees are the profit center. This creates a virtuous cycle that gets stronger over time. Low prices attract members. More members mean more membership fee revenue. More revenue allows Costco to invest in even lower prices. Lower prices attract even more members, and the cycle continues year after year, decade after decade. But here's what really makes Costco recession-proof. In good economic times, Costco thrives because people love saving money even when they have plenty of it. Who does not want to pay less for the same products? In bad economic times, Costco thrives even more because people desperately need to stretch their dollars. When a recession hits, when people lose their jobs or worry about losing their jobs, the first thing they do is look for ways to cut expenses. And Costco is the perfect place to do that. You can buy groceries at Costco for 20 to 30% less than a traditional supermarket. You can buy household essentials, electronics, clothing, all at significant discounts. During recessions, Costco's membership rolls actually increase because people who previously thought they did not need to save money suddenly realize they do. I have studied Costco's performance during every recession over the past 3 decades. In the recession of the early 1990s, Costco grew. In the dot-com bust of 2000 and 2001, Costco grew. In the great financial crisis of 2008, when almost every retailer was struggling, Costco's comparable store sales still increased. During the pandemic in 2020, when the economy was in free fall, Costco was one of the few retailers that prospered. People stocked up on bulk essentials. Membership rolls expanded. The business emerged from the pandemic stronger than ever. Let me tell you about another aspect of Costco that most investors overlook. The Kirkland Signature brand. This is Costco's private label brand, and it is one of the most successful private label brands in retail history. Kirkland Signature products generate over $60 billion in annual sales. That would make Kirkland Signature one of the largest consumer products companies in the world if it were a standalone business. The genius of Kirkland Signature is that it offers quality comparable to name brands at significantly lower prices. Costco contracts with the same manufacturers who make name brand products to produce Kirkland versions. So you get essentially the same product at a fraction of the price. This creates tremendous value for members and tremendous loyalty to Costco. Once you discover that Kirkland paper towels are just as good as Bounty at half the price, or that Kirkland olive oil is premium quality at a fraction of premium prices, you become a loyal Costco shopper for life. The story of how Costco built Kirkland Signature is fascinating. They started by identifying categories where name brands were charging too much relative to the actual quality of the product. Then they found the manufacturers who could produce equivalent quality at lower cost. Sometimes these were the same manufacturers who made the name brand products. They negotiated hard on pricing, leveraging their massive purchasing power, and they passed those savings directly to members. Over time, Kirkland expanded from a few categories to hundreds of products. Today, you can buy Kirkland everything from vodka to vitamins to vacuum cleaners. And in most cases, the quality rivals or exceeds the name brands at a significant discount. I remember talking to a friend who works in the consumer products industry. He told me that Costco is both loved and feared by manufacturers. Loved because a product that gets on Costco shelves can see its sales explode overnight. A single Costco order can be bigger than a manufacturer's entire annual production, but feared because Costco demands the lowest prices and will not hesitate to develop a Kirkland alternative if a manufacturer gets greedy. This keeps manufacturers honest and keeps prices low for members. Now, let me address the valuation question, because I know some investors worry that Costco stock is expensive. The stock typically trades at a premium multiple to the market. The price-to-earnings ratio is often in the high 30s or 40s. Is that too expensive? My answer is that quality rarely comes cheap. Costco deserves a premium valuation because its business model is extraordinarily durable. The competitive advantages are getting stronger, not weaker. The membership base is growing globally. The opportunity to expand in international markets is enormous. China alone could eventually have more Costco warehouses than the United States. When you find a business this good, you do not worry about paying a fair price. You worry about not owning it at all. The China opportunity alone makes Costco worth a premium valuation. Costco opened their first China location in Shanghai in 2019. The response was overwhelming. They had to close the store early on opening day because the crowds were too large. Membership sold out immediately. The demand was far beyond what anyone expected. This tells you something important. The Costco value proposition resonates across cultures. People everywhere want to save money on quality products. The Chinese middle class is hundreds of millions of people and growing. As they get more affluent, they will shop more, and many of them will shop at Costco. The international growth story for Costco is still in its early stages. They have warehouses in Japan, South Korea, Taiwan, Australia, the United Kingdom, Spain, France, and several other countries. Each of these markets represents significant growth opportunity. Japan alone could support far more Costco warehouses than currently exist. The same is true for South Korea and Australia. And they have barely scratched the surface in Europe, where the value proposition of bulk buying at wholesale prices is just beginning to resonate with consumers. What makes Costco's international expansion particularly impressive is that they have not compromised their business model. They did not try to adapt to local markets by changing their approach. They simply brought the Costco model, with its low markups and membership fees, to new countries and let consumers discover the value for themselves. This consistency is a hallmark of great businesses. They know what works, and they stick with it. I have talked to people who have visited Costco locations in different countries, and they all say the same thing. It feels like Costco. The warehouses look the same. The product selection is similar, adjusted for local tastes. The treasure hunt experience, where you never know what interesting products you might find, is present everywhere. This consistency creates a powerful brand that transcends national borders. Let me share some numbers that illustrate just how powerful Costco's compounding has been. If you had invested $10,000 in Costco stock 20 years ago, that investment would be worth approximately $200,000 today. That is a 20-fold return And I believe the next 20 years could be equally rewarding as Costco continues expanding globally and strengthening its competitive position. The business is actually better positioned today than it was 20 years ago. The moat is wider. The membership base is larger. The Kirkland brand is stronger. The international opportunity is bigger. The second retail stock that thrives in every economy is Walmart. Now, I can already hear the groans from some investors. Warren, Walmart is an old company. It is a boring company. The growth days are behind it. It cannot compete with Amazon. And to those investors, I say, you are making the same mistake that people have made about Walmart for decades. People have been predicting Walmart's demise for as long as I can remember. And yet somehow this supposedly dying company keeps getting bigger, keeps getting stronger, keeps generating more cash flow, and keeps rewarding shareholders. Let me tell you a story that illustrates why Walmart is so hard to kill. Back in the 1990s, there was a company called Kmart that was actually larger than Walmart in terms of revenue. Kmart was the dominant discount retailer. Walmart was the scrappy challenger from Arkansas. The conventional wisdom on Wall Street was that Kmart's scale advantage was insurmountable. They had more stores, more customers, more buying power. How could little Walmart possibly compete? But Sam Walton, Walmart's founder, understood something that Kmart did not. The future of retail was about efficiency, about logistics, about using technology to move products faster and cheaper than anyone else. While Kmart was focused on acquisitions and diversification, Walmart was investing in distribution centers, in computer systems, in satellite technology to track inventory in real time. They built a logistics machine that could get products from manufacturer to store shelf faster and at lower cost than any competitor. The results speak for themselves. By the early 2000s, Walmart had surpassed Kmart in size. By 2002, Kmart was in bankruptcy, and Walmart kept growing. Today, Walmart does over $600 billion in annual revenue. That is roughly 60 times what Kmart was doing at its peak before it collapsed. The lesson is clear. In retail, operational excellence beats scale every time. And Walmart has operational excellence built into its DNA. Let me tell you why Walmart is nearly indestructible. It starts with scale. Walmart is the largest retailer in the world by revenue. We are talking about over $600 billion in annual sales. That scale creates purchasing power that no competitor can match. When Walmart negotiates with suppliers, they have to listen. If you are a consumer products company, Walmart is probably your largest customer. You cannot afford to lose that relationship. So you give Walmart your best prices. Those best prices allow Walmart to offer lower prices to customers than competitors can afford to offer. But scale alone does not explain Walmart's durability. Plenty of large retailers have failed. What makes Walmart special is what they do with their scale. They invest relentlessly in logistics and supply chain. Walmart has built one of the most sophisticated distribution systems in the world. They know exactly what products are selling, where they are selling, and how quickly they need to be replenished. Their inventory management systems are legendary.
This allows them to keep shelves stocked with the products customers want while minimizing excess inventory that ties up capital.
I have visited Walmart distribution centers, and they are marvels of efficiency. Products flow in from manufacturers, get sorted automatically, and flow out to stores in optimized routes that minimize transportation costs. The amount of automation is staggering. Robots move pallets, computer vision systems check inventory, algorithms optimize every aspect of the supply chain. This is not your grandfather's retail operation. This is a technology company disguised as a store. And here is something that most people do not appreciate about Walmart. They have transformed themselves into a legitimate e-commerce competitor. A decade ago, people said Amazon would destroy Walmart because Walmart could never compete online. But Walmart has invested tens of billions of dollars in their digital capabilities. They have built a genuinely competitive e-commerce platform. They offer free shipping on orders over a threshold. They offer same-day delivery from stores. They have integrated online and in-store shopping in ways that pure e-commerce players cannot replicate. Think about the advantage Walmart has with their store footprint. They have nearly 5,000 stores in the United States alone. 90% of Americans live within 10 miles of a Walmart store. Those stores are not just places to shop. They are distribution nodes for e-commerce. When you order something from Walmart online, it can be shipped from a store near you, often arriving faster than an Amazon order. You can order online and pick up in store within hours. You can return online purchases to a physical store. This integration of physical and digital is something that Amazon cannot replicate because Amazon does not have thousands of stores scattered across the country. The pandemic actually accelerated Walmart's digital transformation. Curbside pickup, which was a small part of their business before 2020, became essential. Millions of customers who had never used Walmart's digital services tried them for the first time. Many of those customers became regular digital shoppers. Today, Walmart's e-commerce business generates tens of billions in revenue. It is one of the largest e-commerce operations in the country after Amazon, and it is still growing rapidly. What impresses me most about Walmart's digital transformation is how they have used their physical store network as a competitive advantage rather than viewing it as a liability.
Many retail analysts in the early days of e-commerce predicted that physical stores would become stranded assets, expensive real estate that would drag down retailers as they tried to compete online.
Walmart proved that theory wrong. By turning their stores into fulfillment centers for online orders, Walmart created something that pure e-commerce players cannot replicate. When you order from Walmart online, the product might ship from a distribution center or it might ship from a store near your home. This flexibility allows Walmart to get products to customers faster and at lower costs than competitors who rely solely on traditional distribution centers. It is a brilliant example of using existing assets in new ways to create competitive advantage. Walmart has also invested heavily in their grocery pickup service, which has become enormously popular. You can order groceries online and have them loaded into your car without ever entering the store. For busy families, this convenience is invaluable. And once customers start using grocery pickup, they tend to become loyal Walmart shoppers who use the service week after week. This creates a recurring revenue stream that is more predictable than traditional retail, where customers might shop at different stores each week. Now, let me explain why Walmart thrives in every economic environment. In good times, Walmart benefits from overall economic growth. People have jobs. They are spending money. Walmart captures a portion of that spending. But in bad times, Walmart actually benefits more. Here's why. Walmart is known as the low-price leader. When the economy enters recession, when people lose jobs or fear losing jobs, they become much more price conscious. They stop shopping at specialty stores and premium retailers. They trade down to Walmart. This is a phenomenon that has played out in every recession. Walmart gains market share during economic downturns because price-sensitive shoppers flock to their stores. During the 2008 financial crisis, Walmart was one of the best performing stocks in the entire market. While the S&P 500 was down nearly 40%, Walmart stock was essentially flat. And that flat performance dramatically understates how well the business was doing. Revenue grew, earnings grew, market share expanded. The stock just did not go up as much because the entire market was in panic mode. But for investors who held through the crisis, Walmart proved to be a fortress that protected their capital while other investments were being destroyed. I have also been impressed by Walmart's international growth. They operate in 19 countries. They have massive operations in Mexico, Canada, and Central America. They are the largest food retailer in Canada. Their Mexican subsidiary, Walmex, is one of the most successful retailers in Latin America. The Walmex story is particularly impressive. They started with a small joint venture in 1991. Today, Walmex has over 3,000 stores in Mexico and Central America and generates tens of billions in revenue. They have adapted the Walmart model to local markets while maintaining the core focus on low prices and operational efficiency. Let me also mention Walmart's commitment to returning capital to shareholders. They have paid dividends for 50 consecutive years. They have raised that dividend for 50 consecutive years. That is half a century of annual dividend increases. through recessions, through wars, through financial crises, through pandemics. That track record tells you something important about the durability of this business. Management is so confident in future cash flows that they keep raising the dividend year after year. And on top of dividends, Walmart consistently repurchases its own shares. Every year, the share count goes down, which means your ownership percentage goes up even if you do not buy another share. The dividend history is worth emphasizing. Think about all the challenges that Walmart has faced over the past 50 years. Inflation in the 1970s and early 1980s. The recession of the early 1990s. The dot-com boom and bust. The financial crisis of 2008. The pandemic of 2020. Through all of that, they kept raising the dividend. That tells you this is not a company that gets rattled by economic challenges. They have seen everything and survived everything. The valuation on Walmart is reasonable for what you are getting. Yes, it is not a deep value stock, but you are getting a recession-resistant business with a dominant market position, growing digital capabilities, a fantastic balance sheet, and a half-century track record of returning cash to shareholders. When I look at the next decade, I see Walmart continuing to gain share in grocery, continuing to improve its e-commerce capabilities, and continuing to generate mountains of free cash flow. The third retail stock that thrives in every economy is Dollar General. Now, this one might surprise some people. Dollar General is not as famous as Costco or Walmart. It does not get as much attention from Wall Street analysts or financial media. But that relative obscurity is exactly why I find it so interesting, because Dollar General has quietly become one of the most successful retailers in America, and I believe it will continue prospering regardless of what happens to the economy. Let me explain the Dollar General business model because it is genuinely brilliant. Dollar General focuses on small format stores in rural and suburban areas that are underserved by other retailers. A typical Dollar General store is only 7,000 square feet. Compare that to a Walmart supercenter at 180,000 square feet or a Costco warehouse at 150,000 square feet. These small stores are cheap to build, cheap to operate, and can be placed almost anywhere. Dollar General can put a store in a small town of 5,000 people where it would never make sense to build a Walmart. They can put a store in an inner city neighborhood where larger formats would not fit. They fill the gaps that other retailers leave. And here is the beautiful part of their model. Because their stores are so small and simple, they can open new locations incredibly quickly. Dollar General opens over 1,000 new stores every year. 1,000 new stores. Every single year. That is roughly 3 new stores opening every single day. This rate of expansion is almost unprecedented in retail. And each new store becomes productive almost immediately because the model is proven and repeatable. The site selection process is down to a science. They know exactly what demographics work. They know what traffic patterns they need. They know how close they can be to competitors while still thriving. The simplicity of Dollar General stores is a competitive advantage in itself. These are not fancy shopping experiences. The stores are basic, functional, efficient. The product assortment is limited to about 10,000 items per store. Compare that to a Walmart with over 100,000 items. This limited assortment means simpler operations, fewer stockouts, easier inventory management, and lower labor costs. Each store requires only a handful of employees to operate. The whole model is optimized for profitability at the smallest possible scale. This simplicity also makes Dollar General incredibly resilient during economic downturns. When other retailers are struggling with complex operations and high fixed costs, Dollar General can continue operating profitably because their cost structure is so lean. Each store is designed to be profitable even at relatively low sales volumes. This means they can survive and even thrive in market conditions that would devastate more complex retail operations. The consistency of the Dollar General experience across thousands of locations is another competitive advantage. Customers know what to expect when they walk into a Dollar General store. The layout is familiar. The products are predictable. The prices are always low. This consistency builds trust and loyalty. Customers do not have to think about whether Dollar General is the right place to shop for basic necessities. They know it is. Now let me explain why Dollar General is recession-proof. Their target customer is lower and middle income Americans. These are people for whom every dollar matters. They are not shopping for luxury goods. They are shopping for necessities, groceries, cleaning supplies, personal care products, basic household items. These are products that people need regardless of economic conditions. You cannot stop buying food because there is a recession. You cannot stop buying toilet paper and soap. These are non-discretionary purchases that will happen in any economic environment. But here is what makes Dollar General even more resilient. During recessions, they actually gain customers from higher income brackets. When the economy turns down, when people start worrying about their finances, the first thing they do is look for ways to save money. And Dollar General offers significant savings on everyday items. Customers who previously shopped at conventional supermarkets or drugstores discover that Dollar General has the same products at lower prices. Once they discover those savings, many of them become permanent Dollar General customers even after the economy recovers. I studied Dollar General's performance during the 2008 financial crisis. Their same-store sales increased throughout the recession. Their earnings grew. Their stock outperformed the market dramatically. While the S&P 500 was losing nearly 40% of its value, Dollar General was gaining customers and market share. This is the definition of a recession-proof business. When times are good, they do well. When times are bad, they do even better. The 2008 financial crisis was a true stress test for retailers. Consumer spending collapsed. Credit froze. Unemployment spiked. Many retailers went bankrupt. But Dollar General did not just survive. They thrived. They opened hundreds of new stores during the crisis. They gained millions of new customers who were trading down from more expensive stores. They emerged from the recession as a much larger and stronger company. That performance during an extreme economic crisis tells you everything you need to know about the durability of this business model. Let me also tell you about Dollar General's consumable strategy. About 80% of their sales come from consumable products. Things like packaged food, paper products, cleaning supplies, health and beauty items. These are products that people use up and need to repurchase regularly. This creates a steady, predictable revenue stream that is not dependent on customers making discretionary purchases. It also drives frequent store visits, which is important for a retailer with small stores. When your business is built on products that people need to buy repeatedly, you have built-in customer traffic and sales momentum. The grocery business in particular has been a huge driver of Dollar General's growth. A decade ago, food was a relatively small part of their business. Today, it is the largest category. They have added refrigerated and frozen sections to most stores. They have expanded their produce offering. They even launched a new format called Dollar General Market with a fuller grocery assortment. This focus on food has been brilliant strategically. Food is the most recession-proof category in retail. People have to eat regardless of economic conditions, and once you get customers coming to your store every week for groceries, they buy other things too. The financial performance of Dollar General over the past 2 decades has been exceptional. Revenues have grown from around $5 billion to over $40 billion. That is an 8-fold increase. Earnings have grown even faster as operating leverage has kicked in, and the stock price has reflected this growth. If you had invested $10,000 in Dollar General when it went public in 2009, that investment would be worth approximately $100,000 today, a 10-bagger in just 15 years. Now, some investors worry that Dollar General faces competitive threats. What about Dollar Tree? What about Walmart? What about Amazon? Let me address each of these. Dollar Tree is indeed a competitor in the dollar store space. But Dollar Tree has a fundamentally different model. They were committed for years to a single price point strategy where everything costs the same price. This constrains their product assortment and makes it harder to offer certain categories like groceries. Dollar General has a variable price point model that allows them to carry a wider assortment, including more groceries and fresh food. I think Dollar General's model is more flexible and more resilient. What about Walmart? Walmart is certainly a formidable competitor in the low-price retail space. But Dollar General and Walmart actually serve somewhat different markets. Dollar General's small stores go into locations where Walmart cannot operate profitably. Rural towns, small suburban communities, urban neighborhoods. These are areas that Walmart's large format stores cannot serve effectively. So rather than competing head-to-head with Walmart, Dollar General fills in the gaps. And for convenience shopping, for quick trips to buy a few items, the small Dollar General store is often more appealing than driving to a giant Walmart and navigating through a 100,000 square foot building. What about Amazon? Amazon is disrupting many retail categories, but they have had less impact on the dollar store segment. The customers who shop at Dollar General are often less digitally oriented. They prefer the convenience of a nearby physical store. They may not have credit cards for online shopping. They may want to see and touch products before buying. And for many of the low-price consumable products that Dollar General sells, the economics of shipping individual items simply do not work for e-commerce. It costs more to ship a bottle of shampoo than the bottle itself is worth. This creates a natural protection for Dollar General's business model. Let me also discuss Dollar General's real estate strategy, because this is another source of competitive advantage. Unlike many retailers that lease their stores, Dollar General owns a significant portion of their real estate. They own the land and buildings for thousands of their locations. This gives them flexibility during economic downturns. They do not have to worry about lease renegotiations or landlord relationships. They control their own destiny, and that owned real estate has appreciated significantly over time, creating additional value for shareholders. The management team at Dollar General has been exceptionally competent over the years. They have executed their growth strategy consistently. They have maintained financial discipline. They have returned capital to shareholders through dividends and buybacks. And they have continued innovating with new store formats and product offerings. This is not a company resting on its laurels. They are constantly looking for ways to improve and grow. Recently, Dollar General has invested heavily in digital capabilities. They launched an app that allows customers to find products, access coupons, and check out faster. They have tested same-day delivery in some markets. They are using data analytics to optimize product assortment at each store. These investments show that management understands the need to evolve even while maintaining the core value proposition that has made them successful. Now let me bring this all together and explain why these three retailers, Costco, Walmart, and Dollar General, form such a powerful combination for any investor's portfolio. Each of these companies has built a durable competitive advantage that protects their business from competitors. Costco has its membership model and unbeatable prices. Walmart has its scale and logistics superiority. Dollar General has its small format convenience model that reaches underserved markets. These moats have widened over time as each company has invested in strengthening its competitive position. All three of these companies thrive regardless of economic conditions. In good times, they benefit from overall economic growth and consumer spending. In bad times, they benefit even more as price-conscious consumers trade down to value-oriented retailers. This is the opposite of most stocks which suffer during recessions. These retailers actually see their competitive positions strengthen when the economy weakens. All three of these companies generate substantial free cash flow. They do not need to constantly raise capital or issue debt to fund their operations. They produce more cash than they need and can return the excess to shareholders. This is the hallmark of a great business. It does not consume capital, it produces capital. That cash flow gives them options. They can pay dividends, they can buy back stock, they can make acquisitions, they can invest in new growth initiatives. Having excess cash is the ultimate competitive advantage. And all three of these companies have proven track records of rewarding shareholders. Costco, Walmart, and Dollar General have all delivered market-beating returns over extended periods. They have paid dividends. They have bought back stock. They have created wealth for patient long-term investors. This is not speculation. This is proven performance over decades. Let me share my philosophy on retail investing because I think it is important context for understanding these picks. I have always believed that retail is a very difficult industry. Most retailers fail over time because they lack sustainable competitive advantages. The history of retail is littered with the corpses of once great companies that could not adapt to changing consumer preferences and competitive dynamics. This is why I am extremely selective about which retailers I would invest in. But the flip side of that difficulty is that the retailers who do succeed, who do build sustainable competitive advantages, can be extraordinary investments. Because the industry is so difficult, the winners face less competition over time as their rivals fall away. The retailers who figure out how to build moats end up dominating their categories and generating returns that far exceed what you might expect from such a supposedly challenging industry. Costco, Walmart, and Dollar General are the survivors. They are the winners. They have proven over decades that they can compete and win regardless of economic conditions, competitive challenges, or disruption from technology. That track record is worth something. It is worth a lot. Now, let me address some potential concerns that thoughtful investors might raise. What about inflation? Does inflation hurt or help these retailers? The answer is that moderate inflation is actually beneficial for these companies. They can pass along price increases to customers while maintaining or even improving their margins. Their purchasing power allows them to negotiate better than smaller competitors when inflation is running hot. During the inflation spike of 2022 and 2023, all three of these retailers performed reasonably well because they were better positioned than competitors to manage cost pressures. What about labor costs? These are labor-intensive businesses with hundreds of thousands of employees. Rising minimum wages and tight labor markets could squeeze margins. This is a legitimate concern, but I would note that all three companies have invested heavily in automation and efficiency improvements to offset rising labor costs. Costco in particular has always paid above market wages and provided excellent benefits, which results in lower turnover and higher productivity. Walmart has invested billions in automation for their distribution centers and stores. Dollar General has simplified their store operations to require fewer labor hours per store. These companies are not standing still in the face of labor cost pressures. What about online disruption? Could e-commerce eventually destroy these physical retailers? I do not think so, and here is why. All three companies sell products that are not well suited to pure e-commerce models. Costco sells bulk items that are expensive to ship. The economics of their warehouse club model require customers to visit physical stores. Walmart has successfully integrated physical and digital in ways that provide advantages over pure e-commerce players, and Dollar General serves customers in markets that e-commerce has struggled to penetrate. I believe these companies have found defensible positions in the retail landscape that will persist for decades. Let me also share some thoughts on how to think about position sizing with these retailers. Because they are recession resistant, they can anchor a portfolio and provide stability during turbulent times. An investor who is worried about economic uncertainty might overweight these types of recession-resistant retailers. They provide ballast for a portfolio, holdings that you do not have to worry about during market panics. When the market crashes and all the speculative stocks are plummeting, these retailers tend to hold up well or even appreciate. At the same time, I would caution against putting all your eggs in one basket. Even the best companies face risks. Unexpected management changes, competitive disruptions, regulatory challenges. These things can happen even to great businesses. So while I believe strongly in all three of these retailers, I would recommend diversification rather than concentration in any single stock. I want to close by returning to where we started. The retail graveyard is full of companies that seemed invincible at one time. Sears was once the Amazon of its era, the everything store that dominated American retail. It is gone. Montgomery Ward was a retail pioneer. It is gone. Kmart was the discount king. It is gone. The lesson is that sustainable competitive advantage is rare and precious in retail. When you find it, when you find a retailer that has built a true moat, you hold on to it. Costco has a moat built on its membership model and unbeatable prices. Walmart has a moat built on scale and logistics superiority. Dollar General has a moat built on its small format convenience model. These moats are not eroding, they are widening. And that is why I believe these three retailers will thrive in every economy, whether we have boom or bust, inflation or deflation, prosperity or recession. The mathematics of retail are simple. Low prices attract customers. High volume generates economies of scale. Economies of scale allow even lower prices. Lower prices attract more customers, and the cycle continues. These three retailers have mastered this cycle. They have built flywheel businesses that spin faster and faster over time, and investors who understand this and hold for the long term will be richly rewarded. The future of retail will look different from the past. E-commerce will continue growing. New technologies will emerge. Consumer preferences will evolve. But through all of these changes, people will still need to buy groceries, household essentials, and everyday products at reasonable prices. And Costco, Walmart, and Dollar General will be there to serve them. They have proven they can adapt. They have proven they can compete. And they have proven they can thrive regardless of what the economy throws at them. Let me share a few more thoughts on the importance of management quality in these three retailers, because this is something that often gets overlooked. Great businesses can be ruined by poor management. I have seen it happen many times over the years. A wonderful company falls into the hands of incompetent or greedy executives, and within a decade, the competitive advantages have eroded and the business is struggling. What impresses me about Costco, Walmart, and Dollar General is that they have all maintained management continuity and a consistent strategic vision. Costco was built by Jim Senegal, who understood that the key to success was delivering extraordinary value to members. Every executive who has followed him has embraced that same philosophy. They have resisted the temptation to raise membership fees aggressively or to increase markups on merchandise. They understand that their competitive advantage comes from being the low-price leader, and they protect that advantage religiously. Walmart was built by Sam Walton, one of the greatest retailers in history. Sam instilled a culture of frugality, efficiency, and customer focus that persists to this day. The executives who run Walmart still fly coach. They still share hotel rooms on business trips. They still obsess over finding ways to save customers money. That culture is not easily replicated. It took decades to build, and it gives Walmart an advantage that newer competitors cannot easily match. Dollar General has had strong leadership that has executed the growth strategy consistently. They have not gotten distracted by acquisitions or diversification. They have not tried to move up market or change their core value proposition. They have simply done what works over and over again, opening new stores and serving their core customer base. The importance of this management stability cannot be overstated. In retail, execution matters enormously. The difference between a successful retailer and a failed retailer often comes down to thousands of small decisions made every day in stores and distribution centers across the country. Having experienced management teams who understand the business deeply and remain focused on the core value proposition is a significant competitive advantage. Let me also discuss the role that technology plays in these three retailers, because this is an area where they have invested heavily and where they continue to gain advantages over competitors. Many people think of these retailers as old-fashioned physical store operators. That perception is outdated and wrong. Costco uses sophisticated data analytics to understand member purchasing patterns and optimize inventory. They know exactly which products are selling, where they are selling, and what new products members might want. They use this data to negotiate better deals with suppliers and to ensure that their warehouses are stocked with exactly the right products. Walmart is arguably the most technologically sophisticated retailer in the world. They were pioneers in using technology to optimize supply chains. They invested in satellite communications to track inventory in the 1980s, decades before most retailers were thinking about such things. Today, they are investing billions in artificial intelligence, robotics, and automation. Their distribution centers are marvels of technological efficiency, and their e-commerce platform represents one of the largest technology investments in retail history. Dollar General has invested in technology appropriate to their scale and business model. They use data analytics for site selection, ensuring that new stores are placed in optimal locations. They have developed mobile apps and digital tools that help customers find products and access savings. And they are continuously improving their inventory management systems to reduce stockouts and improve store efficiency. The retailers that have failed in recent decades often failed because they underinvested in technology. They did not adapt to changing consumer expectations. They did not build the digital capabilities needed to compete in a world where customers expect seamless online and offline experiences. Costco, Walmart, and Dollar General have all made the investments necessary to remain competitive in an increasingly digital world. I want to spend a few minutes talking about the grocery business specifically because it is such an important part of all three of these retailers and because it is particularly recession resistant. Americans spend over $800 billion per year on groceries. That is a massive market. And unlike many consumer spending categories, Grocery spending does not decline during recessions. People have to eat. They may trade down from expensive cuts of meat to cheaper proteins. They may buy more private label products instead of name brands. But they do not stop buying food. Costco has built an exceptional grocery business. Their food and fresh produce are known for quality, and their prices are unbeatable. Walk into any Costco, and you will see shoppers loading up their carts with organic chicken, premium steaks, fresh produce, and specialty foods. The grocery business drives frequent visits to Costco, which then leads to purchases in other categories. Once you are in the store to buy groceries, you might also pick up clothes, electronics, or household goods. Walmart is the largest grocer in America by a significant margin. Their grocery business generates over $300 billion in annual sales. That is more than the next several largest grocers combined. This scale gives them purchasing power that no competitor can match. They can negotiate the lowest prices from suppliers and pass those savings on to customers. And their grocery business drives traffic to their stores, where customers buy general merchandise as well. Dollar General has transformed itself into a food retailer over the past decade. Food is now their largest category. They have added refrigerated and frozen sections to thousands of stores. They offer fresh produce in many locations. This focus on food has driven comparable store sales growth and has made Dollar General essential to the communities they serve. In many rural areas, Dollar General is the only nearby source for groceries and household essentials. The grocery focus also makes these retailers particularly recession-resistant. When economic times are tough, consumers may cut back on discretionary purchases like clothes or electronics, but they will not cut back on food. The grocery business provides a stable revenue base that supports the entire operation. Let me address one more topic before I conclude, and that is the question of how these three retailers handle different types of economic environments. I have emphasized their recession resistance, but it is also worth understanding how they perform during inflationary periods and during deflationary periods. During inflation, these retailers actually tend to perform well. They can pass along price increases to customers because they are selling necessities that people must buy regardless of price. Their scale gives them negotiating leverage with suppliers, so they often get smaller price increases than their competitors. And they benefit from the fact that inflation makes consumers more price conscious, driving them toward value-oriented retailers like Costco, Walmart, and Dollar General. During deflation, which is rarer but does occur occasionally, these retailers are also well positioned. Falling prices are actually good for consumers, which stimulates demand. And because these retailers operate on thin margins to begin with, they have less downside exposure than premium retailers with fat margins that could get squeezed. The real risk for these retailers is not economic cycles. They have proven they can handle economic cycles of all types. The real risk is competitive disruption or internal execution failures. So far, all three companies have demonstrated an ability to adapt to competitive challenges and to execute consistently. But investors should always monitor for signs that competitive positions are eroding or that management is making strategic mistakes. Now, let me give you my final thoughts on why these three retailers represent such compelling investments for anyone who wants to own stocks that thrive regardless of economic conditions. The retail industry is brutal. Competition is relentless. Consumer preferences change constantly. Technology disrupts established business models. Most retailers fail over time. The graveyard of retail is vast and growing. But within this challenging industry, a few retailers have built something special. They have built business models with sustainable competitive advantages. They have built cultures of operational excellence. They have built loyal customer bases, and they have proven through decades of performance across every type of economic environment that they can compete and win. Costco, Walmart, and Dollar General are those retailers. They are not glamorous. They will never be the hot stocks that everyone is talking about at cocktail parties. They will never 10 times in a year based on some exciting story about future potential, but they will be there year after year, decade after decade, generating cash, gaining market share, and compounding wealth for patient shareholders. That is why these are the three retail stocks I would own for the next decade and beyond, not because they are exciting or glamorous or because they will double next month, but because they are durable, resilient, cash generating machines that will compound wealth year after year, decade after decade. That is what great investing looks like. Finding wonderful businesses and holding them through thick and thin. Costco, Walmart, and Dollar General are exactly those kinds of businesses. And I believe any investor who owns them will look back in 10 or 20 years and be very glad they did.